All right, let's go on to the next one. Number 4. Again, read the last sentence. What is the amount of interest expense that should be recognized by Danes in 2018 using the effective interest method? And so now we go back and read the details of the problem. On January 1st, 2018, Jacobs Company sold property to Danes Company, which originally cost Jacobs $2.66 million. There was no established exchange price for this property. Danes gave Jacobs a $4.2 million, zero interest-bearing note payable. Payable in 3 annual installments of $1.4 million, with the first payment due at the end of the year, December 31st, 2018. The note has no ready market. The prevailing rate of interest for a note of this type is 10%, so there's my yield. The present value of a $4,200 note payable in 3 equal annual installments is $1,400,000. Payment at 10% interest rate is $3,481,800. So to calculate the interest using the effective interest method, we take the carrying value at the beginning of the period, which is my present value at the beginning of the period at January 1st, 2018, times the effective, the yield or market rate, which is 10%. That gives us interest expense for the period of $348,180. All right, let's go on to number 5. We're looking for the amount of proceeds allocated to the preferred stock. And so on July 1st, 2018, Null Company issued 2,500 shares of $10 par value common stock and 5,000 shares of its $10 par value preferred stock for a lump sum of $140. So we have a lump sum issue of common and preferred stock. At the date, Null's common stock was selling for $24, so we know the market value of the common, and the convertible preferred stock for $18, so we know the market value of the preferred. We're going to use the proportion method. So how do we do that? Well, it's relative fair market value. So the number of shares of common times their market value gives me a total market value of 60,000. The number of preferred shares issued, 5,000, times their market value of 18 gives me a total market of 90. Add those together, and the total market value of both the common and preferred together is 150. And I'm looking for preferred stock, so I take the market value of the preferred, which is 90,000, over the total times the lump sum that we purchased or sold them for, and it tells me that $84,000 will be allocated to the preferred stock, and then the common stock we don't have to do, but we just take 60 over 150 times the 140, and that's how we calculate it. Alright, let's go on to the next problem, number 6. Problem number 6, again, read the last sentence. What should Hand report at December 31st, 2018 as total additional paid in capital? And so looking up here, so far there is $900,000 of paid in capital. And so some treasury stock transactions came in, and we should know that additional paid in capital treasury stock is created when we reissue treasury stock for a price above its cost, because we use the cost method for treasury stock. So let's look at the transactions. First, we acquired 2,500 shares of its stock for $75,000. So that means 75,000, 2,500 shares. That means it cost me $30 per share to purchase that treasury stock. And then we sold 2,000 shares at $35 per share. Okay, the treasury stock is going to come out at its cost of $30, and the additional $5 is going to go to a credit to paid in capital treasury stock. So $5, 2,000 shares. That means paid in capital treasury stock got credited for $10,000. And then we sold the remaining 500 shares are left because we had 2,500, sold 2,000 in the previous transaction. Now we're selling the remaining 500 shares for $20. All right, the treasury stock is going to come off at its par value. Okay, we're only receiving $20, so $10 below its cost. And the way we do it, first of all, we go ahead and reduce our paid in capital treasury stock, and we have $10,000 of that. And if there's not enough, then we'll reduce retained earnings. But there's 500 shares, and they're sold for $10 less than their cost, so that needs me that I need to reduce my additional paid in capital treasury stock by $5,000. So my net change for this period for those transactions is a net increase of $5,000 in paid-in capital treasury stock. There was no other transactions, so at the end of this period, I have $900,000 of paid-in capital in excess of par common stock, paid-in capital, and I have $5,000 of additional paid-in capital treasury stock. So together, I have $905,000 of additional paid-in capital. All right, let's go on to number 7. Number 7, we're looking at the entry to record the declaration of the dividend would include a debit to retained earnings of how much? So Farmer Comp owns 20,000 shares of Eaton Corp purchased in 2014 for $550,000. On December 31st, 2017, Farmer declared a property dividend of all of its Eaton shares on the basis of 1 share of Eaton for every 10 shares of Farmer common stock held by its stockholders. The property dividend was distributed on the January 15, 2018. On the declaration date, the aggregate market price of the Farmer stock was $900,000. All right, so how do we do this? Well, step number 1 is we're going to write this up to its market value of $900,000. And then that $900,000, all the Eaton stock is going to give out. So that is the value of the stock that we're going to distribute. And so the debit to retained earnings is going to be $900,000. So I didn't have to make any calculations. I just had to understand that that stock is given out at its market, and the debit to retained earnings is at the market value. All right, let's go on to the last one. And again, what are they asking us? The total on all the bonds outstanding on amortized bond premium at the date of conversion was $280,000. Vogel should record the result as conversion. All right, so we're converting some bonds. Let's read the question. So Vogel has 4 million of its 800% convertible bonds outstanding. Each $1,000 bond is convertible into 30 shares of $30 par value common stock. The bonds pay interest on January 31st and July 31st. On July 31st, 2018, the holders of $1,280,000 bonds exercised the conversion privilege. On that date, the market price of the bonds was $105, and the market price of the common stock was $36. The total on all bonds outstanding on amortized premium at the date of conversion was $280,000. All right, so I need to get to the carrying value of those bonds and determine if I had a gain, and then make my journal entry by issuing the common stock. And so $1,280,000 of bonds out of a total of 4 million means that 32% of the bonds were converted. And so for that unamortized premium of $280 on all the bonds, 32% of it is going to be eliminated because it's for the bonds that were converted into common stock. And that gives me $89,600. This is the premium for the bonds converted. All right, so I'm going to remove face value bonds, $1,280,000. I'm going to remove the premium of $89,600. Common stock is always credited for the number of shares issued times par value. How many shares were issued? Well, let's see. It says each 1,000 bond is convertible into 30 shares. So how many $1,000 bonds do we have? Well, let's take our total divided by 1,000. And then that tells me $1,280. And then each one is convertible into 30 shares. Times 30 shares. That gives me 38,400 shares of common stock will be issued. So 38,400 times their par value of $30 gives me 1,152,000, and the rest goes to PIC common stock. So, looking at the answers here, the only one that works is I have a credit of $217,600 paid in capital in excess of par. All right, next problem. We are going to be, let me just adjust this just out a little. We are going to be issuing what they want us to know in this problem is how much should be allocated to be credited to paid in capital stock warrants. And so on July 1st, 2018, Chen Company issues $9,450,000, a total of 90 shares of $100 par value, 7% non-cumulative preferred stock, along with one detachable stock warrant for each share issued. Each warrant contains the right to purchase one share of Chen $10 par value common stock for $15 per share. The stock without the warrants would normally sell for $9,225,000, so there's the market value of the stock. And the market price of the rights on July 1st was $250, so we know the market value of the rights, so proportional method. And so here's the market value of the bonds, of the preferred stock without the warrants, $9,225,000. Okay, there were 90,000 warrants, market value of $250, total market value of $225. Add those together, total market value is $9,450,000. Now, the amount of the proceeds that we're going to credit to pick stock warrants using the relative fair market value of the stock warrants divided by the total times the price. And so calculate out that we would allocate $225,000 of the proceeds to the stock warrants. Therefore, we'd credit paid in capital stock warrants for $225,000. And finally, the last problem, or multiple choice problem, we want to find the number of shares to be used in computing earnings per share. We need to calculate a weighted average. So we started out the year on 1/1 with 4 million shares, and those were outstanding to April 1st, so that was 3 months. So 4 million times 3/12. And on April 1st, we issued 640,000 shares. So starting on April 1st, there were 4,640,000 shares outstanding. And that was until July 1st, so that was another 3 months. So from 4/1 to 7/1, 4,640,000 shares outstanding times those 3 months out of 12. And then that was then on 7/1, Treasury shares were purchased. So 240,000 shares. That put us at 4,400,000. And that was outstanding until 10/1, so another 3 months. So 4,400,000 times 3/12. And then on October 1st, we issued 100% stock dividend. So it doubled our shares to 8,800,000. And that's all that happened, so that's the rest of the year. That's another 3 months. And then, because we had 100% stock dividend, I have to go up and apply that to the layers above. Shares doubled on the 100% stock dividend, therefore I have to double each layer. Then calculate out, add up, and we get weighted average shares of 8,720,000. All right, the next problem, what we need to do is on April 9th, 2019, when Wolf retired 600,000 of these bonds at 101 plus accrued interest. Okay, now when we retire bonds, if we haven't paid interest, since we have to pay interest to the bondholders that we're retiring the bonds up to that point of retirement. Okay, so that's the first entry we have to make, is that payment. And then we told you that they do that these they chose to amortize the premium or discounts when they retire the bonds. So it says Wolf chooses to amortize discounts or premiums when recording retirements. So how do we do this? Well, let's go ahead. We're 600,000 of bonds. How do we calculate interest? Well, we take the cash payment is Face value of the bonds being retired, $600,000 times their stated rate, which is 7.5%, and we need 3 months. Last paid interest was last paid on December 31st. Okay, now here we are 3 months later. We have to pay that interest that is due before they're retired, $11,250. We're using a straight line amortization, so we're going to amortize the discount. The total discount, the unamortized discount, is related to these bonds being retired. So I did that up here. Okay. Unamortized discount on the bonds is $120,000. Okay. And I know it had a 10-year life, and 2 years have gone by. So what that tells me, it started at $150,000. And how do I know 2 years have gone by? Because the bonds were issued on December 31st, 2016 at 95. And so when they were first issued, 3 million times 0.95, they were issued for $2,850,000. And so I know that I started with a discount of $150,000. Okay, so that means that I so far started at 150. By the end of December, we're at 120. And so I know that we've amortized $30,000 so far. Okay. So how much is that? That's 2 years gone by, $15,000 each year. Alright, the other piece of information I need is I am retiring $600,000 of the $3 million face value bonds. So what percentage of the bonds are being retired? $600,000 divided by $3 million, that's 20% of the issues being retired. So I know that the amortization for my discount is $15,000 for the entire issue. I need it for the 20% that is being retired. And then I need it for 3 months out of the 12 months. That gives me $750. And step number 3, we plug interest expense. All right, now I'm ready to retire it. I'm going to remove the bonds. Okay, I'm going to remove the discount. And I'm going to pay out the cash. And this is $600,000 times 1.01. All right. Now, how do I know what my unamortized discount is? Well, I started at $120,000 for all of it. And then 20% of that balance is for the bonds being retired. So this is the unamortized discount for the bonds, $600,000 face value bonds being retired. Now I amortized another $750. So now my balance is down to $23,000. Okay, let me make sure I can keep that in there. So I did that work again. Started with a December 31st. We had a $120,000 unamortized discount for all $3 million worth of bonds. I needed for the bonds being retired, which is 20% of the issue. So the unamortized premium at December 31st, 2018 for the $600,000 face value bonds was $24. I just amortized another $750. So my unamortized discount on the $600 face value bonds is $23,250. All right, so here's my face value, here's my discount, here's my carrying value. All right, there's my sales price, more than the carrying value, so that difference is a loss. And then I'm going to debit my loss on retirement, and then we always debit the bonds payable for their face value. All right, let's look at the next problem. And the next problem is distributing dividends between preferred and common shareholders based on their preferences. And in case A, the preferred stock is cumulative but not non-participating. In the second case, the preferred stock is cumulative and fully participating. All right, so cumulative. So I just went through right away. I know it's not participating, so steps 3 and 4 aren't required. And then the first thing I always do is calculate what that dividend payment is for the preferred shareholder. Well, they have $800,000. 4% is the dividend rate, so $32,000 is the dividend for the preferred shareholder. All right, and it says that no dividends have been paid or declared during 16 or 17. So there's 2 years in arrears, and in both cases, my preferred stock is cumulative, so I would have to pay those dividends in arrears first. So step number 1, $32,000 a year, 2 years in arrears, so $64,000 would be allocated to the common, keeping my running total, to the preferred. And then the current year would go to the preferred, $32,000. I'm at 96, and the remainder, $174, to get up to my $270,000 of dividends, would go to the common. So in case A, $96,000 would go to the preferred shareholder, and $174,000 would go to the common shareholder. All right, case number 2. Now I'm going to use all the steps, and again, just like above, in the first case, $64,000 goes to the preferred, running total. Then they get $32,000, and then the common get to share at the preferred's rate. So I take the total par value of the common, $1.2 million times 4%, $48,000 they get to participate in. And now the dividend gets to participate, and I did this down below, so let me just move myself up here a little bit. There we go. And I know that the total par value of the preferred is $800,000. Okay, the par value of the common is 1.2. So together, the common and preferred have a total par value of $2 million. And so I just take the $800,000 par value of the preferred to the total of the common and preferred together, time what's remaining. And so here I was at 144. The total dividend is $270,000 minus 144. So there was $126,000 remaining. And so that gave me my $50,400. And I run my total, and again I get 270, so the other 75.6 goes to the common shareholders. So when I'm up, the preferred shareholders would receive $146,400, and the common shareholders will receive $123,600. All right, the final problem is calculating basic earnings per share and diluted earnings per share. So let's look at what we have. We have net income of $2,100,000. We have weighted average shares of 1,340,000. I have some 6% cumulative preferred stock sold at par, and it's convertible into 200,000 shares of common stock. Okay, so right away here I'm going to calculate its 6%, so 1 million total par value times its dividend rate. The dividend on this preferred stock is $60,000. Then I have stock options, exercisable price per share, average market price 30. There's 90,000 of them. And so I know I have 2 potentially dilutive securities. I have preferred stock and I have stock options. And I supplied you with our worksheet that we worked in class on the next page. And so we start out by calculating basic earnings per share, net income $2,100,000 minus the $60,000 of preferred dividend. It's cumulative, they're deducted no matter what. Divided by weighted average shares, that gives me 2,040,000 divided by 1,340,000 shares. We get a basic earnings per share of 1.522. And I told you to carry it out to 3 decimal places. All right, now I'm going to analyze my potentially dilutive securities. And so we know that we have both convertible preferred stock and stock options. So I start out by calculating the per share effect. The numerator effect is 60,000 because if these preferred stock were converted to common as the beginning of the year, we wouldn't have that $60,000 of dividends. and they give me the per share effect, they can be converted into 200,000 shares, and so the per share effect is 0.3 per share. And then there was no convertible bonds, so I don't have to worry about that. And then we have our options. And we always know, we said in class, that the numerator effect for options is always 0. We need to calculate the number of new shares that would be issued. We use the treasury stock approach. So, stock options can be converted to 90 or exercised for 90,000 shares of stock. But I'm going to use the proceeds from those stock options, $25 strike price times 90,000, to purchase some treasury stock. And currently the average market is 30, so I could purchase 75,000 shares. So 75,000 will come from treasury. That means we would have to issue 15,000 new shares. That's my denominator effect. Overall effect is 0. Now we're going to rank them. The one with the lowest per share effect gets ranked first. So options go first. Convertible preferred stock would go second. And so our starting point is where we left off under basic. I was at $2,040,000. There is no numerator effect from the options. Denominator, 1,340,000 weighted average shares, and there'd be 15,000 additional outstanding all year. So that gets me to $2,040,000 divided by 1,355,000 shares. I'm at 1.506, and yes, that is dilutive. All right, go down to the preferred shares, their effect. Start out where I left off above, $2,040,000. If those preferred stocks were converted, there would be no dividend, so I'm going to add back the dividend, $60,000. And then my denominator effect, 1,355,000 weighted average shares plus 200,000 additional shares. If those preferred stock were converted at the beginning of the year, would have been outstanding all year. That gives me 2,100,000 divided by 1,555,000, which gives me a per share of 1.350. That's lower, so yes, this is my diluted earnings per share, 1.350. And I just went to the front and I entered those. My basic earnings per share, 1.522. My diluted earnings per share, 1.350. And that is end of our first exam.